In the world of finance, there are these legendary things, almost like myths. And one of them is a book so rare, so valuable, that it's almost impossible to find. Well, today, we're not just finding it, we're opening it. This is the story of the billionaire's lost book.
I mean, just think about that for a second. What if the real secrets to investing, the kind that build lasting wealth, were locked away in a book you just couldn't buy? Sounds crazy, right? But for decades, that's been the reality for what might be one of the most important investing books ever written.
And here it is. The book is called Margin of Safety. Trying to find an original copy today? Good luck. It's almost impossible. And if you do, it'll cost you a small fortune. But hey, don't you worry about that price tag, because we've done the digging, we've got the wisdom, and we're going to walk you through its most powerful lessons right now.
All right, so before we can even crack open this book, you got to understand the guy who wrote it. His name is Seth Klarman, and in the investing world, he's a legend. They call him the Oracle of Boston.
See, Klarman wasn't just some typical finance guy. He was brilliant, so brilliant, in fact, that while he was still a student at Harvard Business School, some of his professors came to him with this crazy idea. They wanted him, a 25-year-old, to manage their money. Can you even imagine that?
And you know what? He said yes. That one decision back in 1982 was the start of the Baupost Group. And what a ride it's been. We're talking over 40 years of delivering returns that are just staggering, an average of over 20% a year. He took that initial money from his professors and built a firm that now manages over 24 times billion dollars. Now that's not luck. That is a system.
And that exact system is what he laid out in his book, Margin of Safety. But this is where the story takes a really interesting twist. Because this book, it wasn't an instant hit. Oh, not even close.
So picture this. It's 1991. The market is on fire, everybody's making a quick buck, and along comes Klarman with this book all about being careful and managing risk. Nobody wanted to hear it. His message totally fell on deaf ears. The book was a total flop. I mean, he was literally giving copies away. And then, the crash. First, the dot-com bubble burst. Then, a few years later, the 2008 financial crisis. All those speculators got absolutely wiped out. And suddenly, everyone wanted to know the secrets of the few people, like Klarman, who didn't just survive, they actually thrived. That flop of a book, it became a legend. And since Klarman never did another print run, the price for an original copy just went through the roof. So, okay, what's actually in this $1,000 book? Well, the first lesson, and honestly, the most important one, is a simple question that changes your entire perspective. It's this: are you an investor or are you a speculator? And Klarman draws a really clear line in the sand here. A speculator, they're just betting on a price. They're hoping a stock goes up because of hype or some short-term trend. But an investor buys a piece of an actual business. They think like an owner for the long haul. It's a huge mindset shift. Think about it. Are you just betting on a ticker symbol, or are you actually buying a company? This idea leads us right to the title of the book, The Margin of Safety. And this is the absolute bedrock of his whole philosophy. All it means is buying something for way less than what you think it's really worth. So let's say you figure a company is worth $100 a share. If you can buy it for $60, that $40 gap, that's your margin of safety. It's your buffer. It's what protects you when you're wrong, or when the market just goes crazy. Okay, so this whole idea of a margin of safety is the foundation for a really powerful philosophy. The next few lessons are all about getting your head in the right space to actually put this stuff into practice. Now, this might sound a little familiar, and that's for a good reason. It's a classic value investing rule. Klarman just really hammers this point home. Look, your main job isn't to hit home runs. It's to not lose your money in the first place. I mean, mathematically, just avoiding a huge loss is way more important than chasing some huge gain. And this next idea is the perfect illustration of why that first rule is so critical. Klarman talks about this guy called Mr. Market. Just imagine he's your business partner, but he's totally manic depressive. One day, he's ecstatic, offering to buy your stock for insane prices. The next day, he's in a full-blown panic, practically begging you to take his shares for pennies on the dollar. Your job is to just ignore his crazy mood swings, keep your cool, and actually use his irrational behavior to your advantage. This quote really just nails the whole idea of being a contrarian. When everybody else is freaking out and panic selling, that's your time to act. It's so easy to buy that hot stock everyone's buzzing about, right? But by the time you hear about it, it's probably way too expensive. The real money, Klarman says, is made in the stuff nobody wants, the overlooked and unloved companies, especially when it feels like there's blood in the street. All right, so we've got the mindset down. Now let's get into the practical toolkit. These are the things Klarman says you actually need to have to make this work. Okay, I absolutely love this next point. You know how Wall Street analysts try to pin down a company's value to the exact penny? Well, Klarman says that's a total waste of time. Value isn't a single number, it's a range. Your job isn't to get it perfect. It's just to be in the right ballpark. And then, of course, to buy with a big enough margin of safety so that it doesn't matter if you're a little bit off.
So you find a cheap stock. Great. But how does it ever actually go up? The answer is something called a catalyst. See, a company can stay cheap for years unless something big happens that forces the market to wake up and pay attention. Maybe a new CEO comes in, maybe they sell off a terrible division, or maybe they announce a huge share buyback. A smart investor isn't just looking for a cheap stock. They're looking for a cheap stock that has one of these catalysts on the horizon. And here's a hard truth, but one you really need to hear. Wall Street is basically a sales machine. They make money when you trade from fees and commissions. So your broker, they want you to trade more. Your bank, they want you to buy whatever new products they're pushing. Their goals are not your goals. Real long-term success comes from doing your own homework and, most importantly, thinking for yourself.
So after all these rules, all these warnings and strategies, what does it all come down to? It really boils down to one single powerful trait. The one thing Klarman believes gives a regular investor their biggest possible advantage. And here it is. Patience. That's your superpower. In a world that is completely obsessed with speed and moving fast, your greatest edge is your ability to simply wait. To wait for the right pitch, to wait for the market to freak out, and then to wait for your idea to actually play out over time. It's like Klarman says, in the market, money flows from the impatient to the patient. So if we had to boil this entire $1,000 book down to just 3 simple rules, this is what they'd be. Number 1, stay calm, especially when everyone else is losing their minds. Number 2, be patient. Wait for that perfect opportunity. And number 3, when that opportunity shows up, buy a great business at a good price. You know, Klarman's whole philosophy is really a rebellion against the 24/7 noise and the frantic pace of the modern market. And it leaves us with a really powerful question to think about. In a world that's built for speed, is it possible our greatest advantage is actually slowing down? It's a deep thought, and it might just be the most valuable secret inside the Billionaire's Lost book. Thanks for tuning in.